Hi, Steve Van Metre here, and welcome to your weekly economic update where we take about 30 minutes every Friday to take a deeper dive into the markets and the economic data to see if they make any sense. They don't, but it doesn't stop us from trying. So today I've got something very, very interesting that I want to share with you, and it's going to be a preview of what I'm writing about for next Friday, and it has to do with the two most recent Federal Reserve rate cuts and how they didn't work. But I'm not just going to tell you, because you know that that's not how I operate. I want you to see the data. I want you to know where you can go get it. And I'm going to show you that those two rate cuts were duds. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation of buying or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. My own personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advice Inc. or Steven Van Metre Financial. Now, for those listening, just to kind of hear the update of why I didn't rebalance the portfolios, one of the reasons was there wasn't just much going on in the bond prices. We'll get to the charts in a little bit later, and I'll show you that there just wasn't enough to say, okay, this thing's breaking out or pulling back. But there's a tremendous amount of negative sentiment against Treasury bonds just because they're sitting right near their all-time high. And this is kind of where I wanted to see if these speculators and traders and whatnot were going to come in and just really get some traction and try to short the bond market down or sell it down, and they haven't. There's just not a lot of trading going on. So just because there wasn't any major compelling reason to shift, since there's, if it's not going up, there's a potential that it's going to go down. I thought, well, I'll just wait, see if these sellers can bring prices down a bit, and then we would jump in, because we know when the Fed cuts or starts an easing cycle, let's kind of, we'll be more politically correct for the Fed. When the Fed begins an easing cycle that they're not admitting they began, interest rates go down, including long-term interest rates. So we know what's going to happen, because I'm about to show you, well, I've got some other stuff first, but I'm going to show you exactly why those monetary bullets, because Fed, they had 10 bullets in the gun, 2 are gone, and they totally missed their target, And I was really curious to see if it would work. If the second, I knew the first one didn't work because I could see the data. I was just really curious to see if the second one, and it didn't. But let's go take a walk through the charts and see what else comes up. The M2 money supply, the growth rate, you know what? I believe that should say decreased. Well, let's just fix that real fast. Whoops. Boom. Magic of the internet. Growth rate decreased to 5.65%. See, there it ticked down. The 6-month rate of change is at 3.54 and falling. Remember, when the year-over-year growth rate, when the headline gets below 3.7, it says there's a problem. But you can look at the 6-month rate of change, which is leading the 12-month lower, and the 3-month rate of change is at 1.58. And it's like, why is the economy all of a sudden starting to bog down? Because these growth rates are low and are suggesting that a recession is on its way. Commercial industrial loans, the growth rate here also down 5.82%. And remember, I said this was going to continue to fall because the 6-month rate of change is now at 0.2%. So it's almost at zero. And you can see when the year-over-year rate of change breaks zero, we're either in or well deep in a recession. Why is that? Because the 3-month and the 6-month rate of change already went negative and eventually caused the 12-month rate of change to fall. Well, guess what? The 3-month rate of change just turned negative. Not much, 0.81%. This isn't, batten down the hatches, fire up the alarms. No, periodically it does slow. If this keeps falling, it's a big problem. The second problem is the 6-month rate of change shouldn't be sitting at zero. So these two are telling us that the big numbers headed a lot lower. Let's take a look at consumer loans. As far as credit cards, the spending is down to 3.7%, 3.72%. Again, consumers just aren't driving the economy. We know that because retail sales reflects as such. And I can't remember, and I don't think I showed you this chart last time, and the only reason I think that is because the slide was hidden and I may have forgotten to. But a lot of people don't understand why the Asian data matters. And when you're an importing nation, such as we are, we get things last. So the problems start in Asia, flow through Europe, get to the United States. So when we look at South Korea exports, preliminary for the first 120 days, you can see they are in bad shape, looking like they were in 2008 and 9, which again, no one thinks we're going to have a financial crisis, but you can see where South Korean exports are, and then the preliminary, and then the actual exports are following it down. And you can see the S&P 500 trailing 12 months earning per share is looking like it's going to nosedive. So again, what goes on in South Korea does indeed make a difference. So let me get that cleared out of the way. And let's pull up. Nope, that doesn't work. That's what we want. So let's take a look at what's really going on here. And let me just double check. Yep, make sure you see it. So let's take a look at, this is a St. Louis adjusted monetary base. St. Louis, because St. Louis Federal Reserve is the one that tracks this data. The monetary base being all currency in circulation, all money held at commercial bank in deposit, and all money where they're held at the Federal Reserve by depository institutions. So wherever the banks have got the money, whether it's in circulation, sitting at their vaults or sitting at the Federal Reserve vaults, it counts all of it. This is what's called the base money in the economy. And as you can see, here you have effectively the first series of rate cuts, quantitative easing 1, quantitative easing 2, quantitative easing 3. This is really important because we can go back to the financial crisis and say, it worked. Cutting interest rates drove the monetary base up, and it should. You know, when the Fed eases, they're essentially injecting money into the economy. So we want to be able to look at the data and say, well, there it is, or there it isn't. So now that you see, here was ZIRP, zero interest rate policy, QE1, QE2, QE3, and the monetary tightening cycle, we're back where we were in 2013. So I can show you over here, and we're right back roughly where we were in summer of 2013. This also suggests that asset prices should go back to where they were in 2013. Remains to be seen yet, but that's what should happen. So let's zoom in to what happened recently. So the first Fed rate cut was on July 31st, and because the St. Louis Fed updates this chart every 2 weeks, it was coincidental that they had a data point at July 31st. So what we're looking for is an increase in the monetary base, and we want to see somewhere between $60 to $70 billion increase. So this is at 3.3 trillion. So let's go up, and you see, it increased by $31.5 billion. So it fell short. But what makes matters worse is following the next 2 weeks, it collapsed below where it was on July 31st. So that first monetary bullet, that first Fed rate cut, did nothing, absolutely nothing. They literally wasted a rate cut because it didn't work. It didn't. It's right there in the data. Now remember, just in case you forgot, here's here's zero interest rate policy before. Here's QE1, here's QE2, here's QE3. We should see this. We should see this happening here. And I'm not trying to cheat. Let's go and see if we can find it. See, here you can see, boom, 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 boom. There it is. Nothing. Now, the next rate cut came on September 18th. Unfortunately, there was not a data point for September 18th, but we can go and look at September 11th, the next closest one. So we have 3.287 trillion, and in the 2 weeks following, so right in the middle of here, if there was a data point, but they don't update it every week, there would have been the rate cut, and you can see it dropped from 3.287 to 3.180. A huge, huge decrease of, 93 billion? Substantial. What this is telling you is the second rate cut didn't work either. It didn't work. at all. So now you know. Fed's policies aren't working. Now, what does this mean from an investment standpoint? So you're an investor, you're nervous. Man, should I be back in stocks? Are stocks going to work? No, because look, the monetary base is telling you the Fed's ability to support asset prices is not working right now. Not working. So what does that mean for asset prices? They should continue to go down. What does this mean for a bond investor? Well, it means wonderful things. Because when the Fed's policies are ineffective, they're going to reload, right? And I got 8 bullets left, 2 are gone, and they're going to fire some more. When at the end of October meeting, they will be reloading, ready to go. Will they fire 1 and make another mistake? Fire 2, do a 0.5% cut, full rate cut, go to 0? Don't know. But what I do know is they've got 8 bullets left in the gun before QE. And when QE kicks in, bond prices go. Well, actually, bond prices kick in before that, because when the Fed starts buying bonds and it has no effect on the economy, they're buying bonds in a tight financial condition and drive interest rates down, bond prices up. Pretty sweet, right? Okay, let's go back. And now let's turn this into world dollar liquidity. Now, we're not going to add on the amount of foreign-owned treasury securities. They did drop by $6 billion, but because that was, while it updated monthly, it's not updated here until every quarter. So I can't just throw it on here. So this is world dollar liquidity. Since 1970, it's not going back to 71, but it should. Anyways, nevertheless, anytime world dollar liquidity falls, you get an economic slowdown or a recession. Hence, you can see it slowed down here. So let's move forward to where we're at now. And you can see world dollar liquidity, again, I'm omitting the part that hasn't really changed, is dropping at around 10% a year. Now, why is that structurally important? Because world dollar liquidity, on average, since 1971, grows at 20% a year. It's at minus 10% a year. There's a 30% differential. Do you want to know why things in Asia are so bad? Because they don't have enough dollars. Do you want to know things in Europe are bad? They don't have any dollars. Do you know why things in America are not great, but are going to get a lot worse? Not enough dollars. When you're in this is really simple. You can look at it as gold, right? Remember, back when gold was the reserve currency, there's a finite amount of gold, finite amount of mineable gold on this planet. Even though the planet's lined in gold, we cannot get to it. So if you took the total world gold supply, and let's say you cut it in half and it just magically disappeared. An alien came in, it's like, oh, look, a bunch of gold, took it and disappeared. The global economy would have got cut in half because it was a gold and the gold standard. Guess what happens when you're on the dollar standard and you destroy dollars? You shrink the global economy. That's what's happening. That's why this is so important and why nobody really understands it. So let's take a look at what the banks are up to last week. Again, give me more warm and fuzzies about taking on more risk in the bond market. You can see mortgage. Let's see, where are we at? Treasury and agency securities. There was a big increase. Let's see the breakdown. They picked up about $3 billion worth of mortgage-backed securities, but this is fairly large. $21 billion in U.S. Treasury securities. This is huge. And then looking at other securities that were fairly flat. So they picked up $4 billion? Huge. About $23.5 billion worth of bonds purchased by the banks. And as a reminder, when banks buy bonds, especially mortgages, so here you can see Treasury and agency securities, mortgage-backed securities, all commercial banks, not at their all-time high, but inching up there, interest rates go down. And I have 30-year interest rates inverted, so we know the banks are keeping a floor into the bond market, hence why I just wanted these speculators to really just exhaust themselves with whatever selling, because I knew interest rates were going to fall when they're done. So it's just a matter of waiting it out. Let's take a look at the NASI, the NASDAQ McClellan Summation Index. Liquidity popped up and is now starting to reverse direction. Pretty evident today, at least when we look at the markets. And let's talk crops for a minute. before we look at that. So I spent some time the other day, digging around, and I got a really good perspective from a farmer who's been really good about, providing weather information and what's really going on the ground. And some of the things he mentioned I had not heard yet, but they're very interesting. So he said in the southeast, there's a lot of heat and rain. And he says what a lot of people don't realize is when you get heat and rain on crops, you get mold and mold-related diseases. And he's like, it's pretty bad. And he said, now he didn't say there was mold. He didn't say he was reporting it. He just said that can happen and it would be very bad. The other factor he mentioned that I had not heard yet, and this is really interesting to me, he actually broke down where it's going on in the harvest. So he says the early harvest is going on now. And he says this was planned at the optimal time in the optimal areas. And he says there are parts of the Midwest and the farming region that are much better than others. And if you're in the ideal zone, no problem. And he said these early crops are not coming out as well as anybody thought. They're coming out below average. He said the bulk of the harvest will not start until mid-October, and it will run into early November, which he says is extremely late. And he said if the crop in the ideal area is any indication of what's coming, he says it's going to be way worse than anybody realizes. The other thing that he mentioned was that even if the crops come out wonderful, and he said they won't because he's seen plenty of them to say otherwise, he said what a lot of people don't realize is fall planting needs to start somewhere in October. So he says this late harvest is going to keep farmers from planting their fall crop. And he said the world's not ready for that yet. And I thought that was interesting. And of course, all of that is assuming there's no frost or inclement weather. So we see this really cool area coming in that's starting to spread into the Midwest. There was going to be snow in some parts over here. Don't know exactly where. This is not a snow map, but it says things are going to be really cold compared to normal. And look at the rain. They're going to get a huge amount of rain, above average rain through the Midwest. They do not want rain right now. Farmers want hot, dry weather to finish the crops. They don't want rain. Rain and heat equal mold, and rain and cold equal frost. So you get the idea that they don't want rain. Well, looking out to the 8 to 14 day, you can see, and this is what I said, if this cooling pattern starts to pull down into here, and you can see it start looking like it's going to move south, and you get rain, more above average precipitation, you start running the risk of frost. And he said all it will take is a little bit of frost and the crop will be ruined. So I thought that was pretty interesting. All right, let's get on to some charts and see what's going on here. All right, so the S&P 500 had a day of illiquidity. Stock prices just at one point was zoomed in to the daily here and you can see it was just and then and this move down was not matched by Treasury yields. So you can see Treasury yields, you can see, okay, well, they're down. This closes a half hour before market. So they weren't down quite this much, but this wasn't a big move. Here you can see close of yesterday. Here's close of today. Wasn't a big down move at all. So it tells you today's drop in stock prices was not a risk-off move. It was not a flight to safety. It was a liquidity issue. How do you know that? Volatility went up. So you can see people started hedging volatility because stock prices started moving and there wasn't a lot of money. And on Monday, you're going to have 3 Treasury auctions settle, which means people had to pony up some money. So volatility should continue to be a problem, especially since banks are needing overnight loans. I mean, that's a problem. But the S&P 500 did touch its 50-day moving average, and people like that. And you can see they bought on that move and brought prices up a little bit, but they're fighting an uphill battle there for sure. Going back to Treasury yields, you can see their 10-year Treasuries are kind of just tagged or almost tagged in overnight trading their 50-day moving average. Again, a bearish sign for yields, validating virtually everything we understand about how interest rates are going to perform going forward. 30-year yields, I thought we're going to get this gap in here closed, and they didn't quite get there. So my thought is there may be one last valiant effort to push yields up into next week, but it probably will be a fleeting effort as the 50-day moving average here also continues to roll down. Now, from a bond price perspective, going to the opposite end, looking at symbol TLT, 20-plus year treasuries, you see not much price movement here. So yes, we see that prices came up here, hit resistance. Now the question is, some people that are bearish on treasury bonds see this as the first move down, kind of a relief rally, and then the beginning of the next wave down where they say we'll take prices somewhere down here. Not with the banks buying. The other thing you can look at is saying, well, maybe this thing just got a little overcooked, most likely, and it's taking a breather here, letting the sellers come in and, letting price, bonds exchange between buyers and sellers until the sellers are exhausted, and then you get the final move up in a plunge in stock prices. That seems what's more likely here going on because, again, the banks are big buyers of bonds. What looks to be in trouble is oil and gas producing stocks have now completely erased their ramp from the Saudi oil field strikes and are not in a good shape. They're below their 50-day moving average, trying to find support in here. But reality is when you understand that world dollar liquidity is contracting and oil is priced in dollars, guess what happens to oil prices? They have to contract. So it's the way it goes. Looking at short-term bonds, these are sitting under their 50-day moving average, under a little mid-range of resistance here. Again, the Fed's buying bonds has not had a huge impact here. Let's see, what day would the Fed have bought? They would start buying probably right here on the 19th. So you can see the Fed's not having a big play because there's a lot of people shorting the bond market, trying to get interest rates to go up to help boost stock prices, and it's not working. Let's take a look at ag commodities. A little pullback today, but with the coming weather and a potential fall planting dud that no one is pricing in, the market's clearly nobody's pricing in. There's just nothing but upside potential here as we get closer into the main harvest season, where we'll start to get some real data on what's going on. Let's take a look at crude oil. We can see it's kind of fluttering around. There is buying interest here. People are trying to push prices up, but they're not finding a lot of strength in this at all. Taking a look at gold, forming what looks like a topping pattern, more easily seen here in the junior miners. This is clearly a topping pattern. I mean, this thing cannot break out to new highs, and it's looking like it's sitting on a shelf here, and that's how you know it's going lower. See, TLT doesn't look that way. It looks like it could be forming a top, but if it is, it's not there yet. It would need to make some more moves before that happened. Otherwise, you have to assume that this is just it catching its breath. This, on the other hand, you can see it tried to make a high, tried to make it high, didn't make it, tried to make it again, didn't make it, came down to support, tried to find buyers, couldn't find that many, back into support, and found sellers, and when they break, that whole thing's going to unwind, as it should. Until the Fed turns on the big spigots, that's exactly what should happen. A couple interesting things. Take a look at Apple. Again, I said Apple needs to really drive the market. Got, not quite at its all-time high, but kind of was nudging back there. I said Apple needs to break out of this sell zone, and it did, but it needed to keep going, and so far it hasn't. So Apple really needs to get, even if you want the market to go up, you need to really be buying Apple to get it to go up. I'm not saying you should buy Apple, but if Apple breaks down here again, well, that tells you, hundreds of billions of dollars in share buybacks don't get you anywhere. One thing that does concern me is looking at PG&E stock. Not that I know exactly what's going on with PG&E, but everyone thought this was the buy of the century. Turned out to be a major topping pattern as investors sold, and then it dipped, people bought in, and now it's turning into another topping pattern. See how it's bouncing off support here, but if it breaks through support, it's going to revisit its lows. The concern is, what bad things does that bring to the market with it? I don't know. But looking at former market leaders, we looked at this Netflix looking like it's headed lower and taking the market with it. Facebook, a former market leader that's heading lower. So again, some of these former market leaders that were these stocks to own are slowly giving up their lead. And the dollar is going to be causing problems because when the dollar rises, it tightens financial conditions. The U.S. Treasury has still not started its big borrowing binge for some reason or another. I don't know. But when they do, it should add to a strengthening dollar, bring gold down, bring oil down, bring stocks down, and bring the economy with it and send interest rates also lower. And while we're here, let's take a look at emerging markets, which is setting a series of lower highs. And again, when emerging markets break through this zone here, you're talking recession city or major plunge in stock prices, one of the two. And so you can see emerging markets should head lower as, again, the dollar picks up strength. So I think that's going to be, we'll probably wrap up here early because that's pretty much what I got. I really wanted to show you that monetary base and show you that the Fed's policies aren't working. It has major implications. But if you're a bond owner, it's really good news because it means their policies are ineffective and they will have to do more and more and more. And the more they do, they will send interest rates down. And if you're a stockholder, well, I wish you the best of luck, and maybe you'll be right this time. I don't know. There's a first time for everything. So I'm Steve Van Metre. We'll be back Monday to take a look at how the hedge fund managers are doing, and then we'll hopefully get the portfolios rebalanced ahead of next week's non-farm payroll report, which should be out Friday, because I don't believe it'll look good, but we'll review that data again probably next week. So I hope you have a great weekend. Bye now.